Energy stocks on pace for their worst week in over a year. This as crude oil sees 3 straight days of losses amid supply concerns. But is there a turnaround in sight? Welcome to Trading Nation, folks. Today we've got Kim Forrest from Fort Pitt Capital Group, and Larry McDonald is here with the Bear Traps report. Let's go with Kim today. What do you think? What's going on here with oil?
Well, it looks like we have a whole lot more supply than we thought we were going to have, and I think it has everything to do with the price going up and drillers doing what they do best, which is drill.
That's simple? That's it? Usually people give much longer answers, so I'm not ready to respond this quickly. I was looking at my notes, but that's great. So we'll go right to Larry. Can you keep your answer as succinct as Kim's?
I doubt it. Kim's pretty quick, but I'd say this. Listen, the global economy for the last 7 years, the IMF in the third or fourth quarter, each year for 7 years, has taken down their previous estimate on the global economy that they issued in January. So it's really 7 air balls in a row. This year, they raised the estimate. So the global demand is the wild card. That's what I think is in the works and surprising people, and that's why there's upside ahead for some of the oil names.
I'm going to send it back to Kim, just because your answer was so short. I want you to have more time to be able to sound like a true Wall Street strategist type, where you just give me all the details.
Well, it really feels like, especially in the U.S., oil is range bound between 40 and 60, because we've seen it creep up, and whenever it creeps up above 50, the horizontal drillers, the new technology shale drillers, it brings them out of the woodwork and they add to the supply. It really is that simple. I agree with Larry that this is the first time the oil or the energy use has been revised upward, but I still think we have way too much oil sloshing around the world. And if things like Venezuela would ever come back on in a meaningful way, we'll have even more. So I think that we have so much supply, and that is going to overrun demand at this point. And
then Larry, I'll just let you finish with something short to balance out your longer answer.
Well, here's the most important, I think one of the most important things. First of all, Kim's thesis is a good one, but it's very crowded. Like over the last year, a lot of people are talking about the speed at which the supply can come back on. So that's a very crowded view. And most importantly, $1 trillion of CapEx, $1 trillion has come out of this space since 2004. And those are capital expenditures that oil and exploration companies make. So that means that if you have a spike in demand, you just don't have that the capital that's in position to get the oil out if demand really increases.
All right, Larry McDonald, Kim Forrest, thanks for joining us here on Trading Nation. I'm Eric Chemi. We'll see you next time. I'm ready. I'm ready. Welcome to Trading Nation, folks. Check out the consumer staples chart. It's been on a tear. The sector's up 1% Thursday, thanks in part to Walmart, which was up more than 8% in the session. The group now on track for its best month since February. Are there more gains ahead? Larry McDonald and Kim Forrest are here today. They are your Trading Nation traders. Larry, you say staples could be a major catch-up trade into year-end. Let's talk more about that.
Well, especially over the next 6 months. Well, first you have the tax loss selling issue that we've been talking about. But most importantly, the underperformance of this sector is almost 10% since June versus the S&P. And you have a situation where if the market corrects because of this tax bill running into some problems over the next month or so, and say it gets pushed back, as the market rolls over and goes into some type of correction, that's when historically, that's when this sector, the defensive stocks, dramatically outperform. So it's a safe place to be in a storm, and it's a great place to be year-end tax loss selling, and if the market rolls, you're going to outperform the S&P quite dramatically.
Kim, I know at your firm, you tend to look at things from a value-oriented point of view. Where's the value right now in consumer?
Well, the value right now is being left behind by investors. I mean, let's just say that. The S&P and the Qs have been driven by the big five, FANG plus Microsoft. And let's not forget that. I think we've seen a rebound recently in things like staples and utilities because the people who are leaving GE and who were in GE for the dividend are looking for a home for that money where it is going to return dividends. And typically staples and utilities, for that matter, are two places where you can get kind of steady eddy, or so investors think, returns or dividends paid out to you. That being said, you know, I would love it that value would come back in style, and a market that does nothing that goes up is not going to give us that. So, you know, looking into the future, I'd be happy if Larry's thesis comes to pass. But at this point, the market marches higher, and it really is driven a lot by those that top five, you know, market cap stocks.
I'm going to throw a curveball to both of you guys because I was having a chat at my desk with some other CNBC folks, and there was this question about, do people buy the stocks of the companies that they shop at? You know what I mean? So if you're a Walmart shopper, are you more likely to buy Walmart the stock? Is that something you guys have ever thought about, researched, traded on? I'm just curious both your perspectives on that.
Who do you want to start?
Whoever is more confident enough to jump in with the answer first.
Go ahead, Kim.
Well, you know, even though I don't necessarily have clients, but I talk to our clients, and I generally get to answer their question about, I like this company, can I buy the stock? So I would say yes, that generally the retail investor is more likely to buy companies that they've actually dealt with. So that I agree with that.
Larry, what about you?
Well, for young people watching us right now, I think one of the great lessons of my career on Wall Street has been around this subject. And through your life, especially as a young person, something comes at you like a new product, or like a, you know, you see lines in front of Chipotle, say 4 or 5 years ago, and a lot of times you take it for granted and you don't pay enough attention to it. And typically, when you see that in life, when you see that new product that you're using, or when you see something unusual in the marketplace, buy the stock, because most times you'll be fairly early and capitalize quite brilliantly over time. Is
there something, Larry, that sticks out to you as a company right now in the consumer space that you think, oh, you know, this is actually doing really well or really poorly, the stock price doesn't match that, I think there's a trade here?
Well, yes, in the electric vehicle space, you've got things like uranium. I mean, the amount of electric vehicles that are coming into the marketplace over the next 10 years globally is just a very, very daunting task, and you're going to need many more nuclear power plants globally to meet that demand for electricity that comes from electric vehicles. So uranium and trades in that space, that's what I'd be focused on, is really electric vehicles and anything in that electric vehicle supply chain.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.